Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us remotely, we have Chris Donraj. He's the head of iShares Investment Strategy at BlackRock. We also have Steve O, who's the head of ETF Listings and Product at Nasdaq. And we're going to take a look at the value proposition of gold in investment portfolios. Gentlemen, thanks so much for joining us. And certainly in surreal times in the market right now. Chris, I want to start with you. Can you comment on recently approved fiscal stimulus policies and the attention that it's placing on gold?
Absolutely, and thank you for having me. So year to date, gold is up 4.4%. And it's playing an important role as both a diversifier and as a store of value as fear is quite high. With the announced QE measures from various central banks globally, investors are looking at gold as a safe haven during these volatile times.
All right, and Steve, I'll ask you to follow up as well.
Sure, and I'd like to add a little bit more detail into the recently approved fiscal stimulus for COVID-19, just to give you a sense of the magnitude of the government support of injecting cash into an economy to help people and businesses impacted by this challenging global pandemic. The package is $2 trillion, and this has raised some concerns because this package will add on to an existing $23.5 trillion in U.S. national debt. And so investors are looking at gold not only as a safe haven from stocks and bonds, as Chris has alluded to, but also as a dollar inflation hedge.
All right, and Chris, can you explain the value proposition of gold in investment portfolios?
Absolutely. So if you look at, the past 10 years, gold has actually had very low correlation to equities, only about 1% correlation with U.S. equities. It has a little bit higher of a correlation with bonds, about 39%, but importantly, it has a negative correlation to the U.S. dollar. So when you think why gold is in portfolios, along with equities, along with fixed income, along with cash, it plays that role as a diversifier.
All right, and Steve, there's a difference in investing in spot gold versus gold miners. Can you please elaborate there?
Sure, and I'll reference the slide that the audience is looking at right now. And what you're basically seeing is that there is a correlation in movement between the price of the spot gold and gold miners. And that makes sense, right? When gold goes up, the price of gold goes up. The miners who mine the ore, they can sell the ore for a higher price and therefore realize a increased profit. But one of the challenges is that there's an increased magnitude of price movement, which indicates that the miners are going to be more of a beta play. And some of this is reflected in that the gold mining companies will carry other, call it company or industry specific risks, including leverage, credit, and as well as product demand.
All right, and what are some of the important considerations to make when investing in gold ETFs versus holding the actual bullion, Chris?
So I think they are a related play, right? One has a bigger beta than the other, but the important consideration is gold as an asset class is a bet on inflation and deflation, essentially, and also a bet on liquidity. Gold miners take advantage of all of those others, theses, but they also are a bet on the company. So you have things like earnings. You have areas like CapEx and guidance and management. And so there's an extra level of consideration, which I think contributes to the higher beta of gold miners versus regular gold as an asset.
And Steve, I'll ask you to follow up.
Sure, and we'll also talk about let's say investors who some of the gold bugs out there that like to actually hold the coins or the bars, and so some of the call it the trade-offs are that when you're actually looking to buy the actual gold bullion, is that there generally is a markup where 3%, 3 to 4% is actually often considered reasonable. So there is a cost. Actually holding the gold bullion or bars is quite heavy. So the bars that you see in the movies, they represent bars that are generally about 400 ounces or 27 pounds, and they cost over $500,000. And then finally, you've got to take these gold bars and store them in vaults and insure them. If you're in the ETF, well, with the ETF, you don't have to quite deal with these heavy, cumbersome bars. But at the same time, you are paying a small management fee to someone to do that for you. And then for those gold bugs that I mentioned before, they oftentimes like to have those coins and bars because you don't actually have the gold in hand and quickly available, which might be a deal breaker for some of them.
Steve, are the gold ETFs liquid?
Of course, they're very liquid. I wanted to refer you to the chart that you see, and the top part of the chart reflects the recent price movements in IAU, which is a black iShares spot gold ETF. And then on the bottom part of the chart in green, those bars actually associate daily trading volume. And this is year-to-date 2020 data. And what you're basically seeing is that with the recent volatile moves, because of the market volatility, you're also seeing significant spikes in trading volume, oftentimes 2 to 3 times daily trading volume. And the point I'm really trying to make here is that gold ETFs, like other ETFs, can absorb volume much larger than ADV, average daily volume, because of its open-ended structure where liquidity providers can create or redeem ETF shares based upon changes in demand.
Chris, can you discuss what you've been seeing in flows to gold in the commodity space?
Absolutely. So if I look at the flows, flows into gold ETF holdings, are near all-time highs. I think what we've seen, which is a contrast versus last year, is that last year we saw gold ETF flows of around $19 billion. And if you think about, considering it versus where we are now, in 2019, we saw U.S. gold ETF inflows of around $10 billion. Year to date, we've seen about $3 billion of those flows in the first few weeks of this year. But importantly, we're starting to see, I think, a broader appreciation for not just gold, but other commodities as a place in portfolios. Certainly, though, the announcement of a renewal of QE has brought back this idea of gold as an inflation hedge, possibly as a deflation hedge as well, with all of this new liquidity out there.
Steve, any final thoughts?
Sure. I would like to point out that the access that ETFs provide for different asset classes, for example, like gold here, ETFs are a democratizing investment vehicle that allows a broad spectrum of access to many asset classes otherwise unavailable to many investors. So if you aren't able to buy a $500,000 gold bar and store it safely at home, you can always buy the ETF through your brokerage account for under $20 a share.
And Chris, we'll leave you with final thoughts.
Absolutely. So I think, the key thing that investors have really been asking us are about the diversification benefits of gold, the low correlation or negative correlation to equities and fixed income in the dollar. But I think the other thing that's interesting is if you look back from the 2008 example, initially, what was interesting is that as news came in on the negative side during the great financial crisis, gold initially failed to act as a safe haven. However, once QE programs were announced, in particular the $600 billion QE program announced in November 2008, gold really started to have legs and begin to climb despite the softness of performance in both equities and bonds. So in some ways, the quick announcement of QE and central bank support, I think, has really kept the support under gold as an asset class.
All right, Chris and Steve, thanks so much for joining us on Trade Talks. And thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.